Welcome to Investment Pitfalls to Avoid when you're advising divorcing clients. I'm Jacki Roessler. I'm a CDFA. I've been a CDFA for about 25 years as Divorce Financial Analyst. And I'm thrilled to be joined today by my colleagues, Melissa Joy. Melissa is a CFP and a CDFA also, and she is the founder and president of Pearl Planning, where my colleague Melissa Fradenburg and I both work. And Melissa Fradenburg is in our Grosse Pointe office. She is a financial advisor and also a CDFA. And we are really excited to be able to present this information to you today, because this is a topic that has been on our minds for quite some time, especially with all the changes going on in the market. We get questions from clients post-divorce and during divorce about how to handle some of these different investment assets that they have. So for today's agenda, we are going to be covering the things that we think are the most timely and important to discuss right now. So when we do a lot of webinars for attorneys and for people that are in the process of and considering post-divorce. Whenever we do these, we're always looking for what is timely. And right now we feel like these three topics come up again and again in our practices, and we want to make sure that we provide education and information as a resource to everyone that's on this webinar or on the replay. So the first topic we're going to cover is how to divide non-standard assets in the marital estate. We are also, do you mind flipping it back to the last slide? Thank you. I don't have it memorized. I should. So the second topic that we're going to cover is why cost basis matters. And it's critically important when dividing assets. And it often gets overlooked as the way that we end up seeing it. And last, but certainly not least, is going to be how market volatility and rising rates are impacting divorce negotiations today. So as far as the non-standard assets in the marital estate, there are many. We're just picking a few that we want to cover, but we're going to be covering cryptocurrency, equity compensation for employees, and some really unusual things that we've been running across, such as precious metals and even oil and gas investments, and how you handle those within the divorce context.
So I'm going to take over for a moment. Thank you, everyone, for listening. Digital assets are something that are increasingly just a part of our world, whether you like it or not. Sometimes as a financial advisor, I just attended a presentation that was all about why we hate digital currency. And I was like, yeah, I get that, because it's very difficult to consider from a regulatory point of view or from an old school point of view. So you really have to know your stuff. But a digital asset is just something that is not, calculated in dollars and cents. And one good example that I think is relevant and we can all understand is frequent flyer miles. So that's something that has a value, but it's not exactly tied to something that can be easily divided or can be taken from one account to another. I recently was talking to a client who was talking to me about how she knew why her husband wanted that credit card. She figured out because all of the frequent flyer miles were attached, but it was a little too late to, after the divorce, kind of was settled, to go and be like, I'd like my miles back. But there are some new and emerging areas of digital assets that are very important for everyone in the family law community to be familiar with today. So cryptocurrency is increasing, and of course one of the assets that is most related to cryptocurrency is Bitcoin, but there's a wide variety of cryptocurrencies that are basically a decentralized finance store of capital. We're going to talk about more about those in a second. Over the last 18 months or a few years, NFTs, which are digital assets that have that are images or likenesses that have ownership and sometimes have value, widely variable value, as the case may be in 2022, those are also important digital assets. They can have a huge value and store of wealth. And you may think, I'm never going to come across that. But what I'm learning when we ask people in both in family law cases, as well as just in general financial planning, is that you would be shocked about how many people either have ownership of digital assets or have intent to own over time, especially when you're working with younger people. And when I say younger, I'm not talking about 19-year-olds. I'm talking about 30 somethings, 40 somethings. It is important to make sure that you are asking whether there are any digital assets. This is also something where one member of the family may be very familiar and have been doing this on the side, and the spouse has no idea. So, and that relates to, I'm going to spend more time specifically on cryptocurrency. And like I said, this is Bitcoin, Ethereum, a variety of assets. But these are coins, in essence, that are intended to be used as a store of value. And the idea for some people is that you could eventually be using these instead of your typical wallet. So a digital wallet, you go to Starbucks, you pay for your coffee with your Bitcoin instead of your dollars and cents or your debit card. That's for some people the intent of these digital assets. They also, though, were generated out of kind of a desire to have less information available to traditional parts, the kind of centralized world of finance. So who would have interest in less information available? Perhaps people that want to launder money, perhaps people that have criminal intent. It's kind of the Wild West when it comes to both the regulation, the safety, and and definitely the price of these types of assets. So for example, you could have valued your digital currency at the end of last year when you did a financial affidavit, if you happen to know that there were that there was Bitcoin involved, and you would have a radically different value today because there's such volatility, and there's been, in this case, a loss of value, but in other years a huge gain in value. These types of assets change their price 24/7. So this is one of the reasons, as a financial advisor, I don't love them. I don't want to have to be worried about the price of something on a Sunday afternoon. We like to take Monday through Friday to focus on the stock market and take a couple days off, and that just doesn't happen in this world. So when you think back to the fact that these digital assets were created by people who had interest in privacy of their assets, what does that make you think in the realm of divorce? Well, I just attended a presentation that was all about digital currency from a financial planner perspective. And one of the main slides was how this is a new kind of frontier for hiding assets when it comes to divorce. So, there are not statements. Sometimes you don't have an idea of where assets are being held. It's murky. It's a murky world. And so you really need to be aware of that and make sure you're asking appropriate questions. And when you do identify digital assets, don't take someone's word for it about the value. You may need to do your own research because the information available may or may not be accurate. So there's a lot of gray area. Like I said, this is a complicated area, but I think it's increasingly important because of so many people have digital currencies. And while in the financial planning world, we don't know, it's difficult because we are regulated about how we recommend things to people. And there are a lot of pitfalls to these assets because they may or may not be safe. The digital wallets that they have could be subject to hijacking, kind of piracy, just like the piracy on the open ocean. But the reality, and so the people that are like kind of the most thoughtful in this area may say that you might only have 1% to 5% of your net worth in these assets. But we've seen people who've had north of $500,000 or $1 million of exposure in digital currencies where they might not have any other exposure to anything. So don't assume that these are just, kind of throwaway assets. And especially if someone is looking to walk away with more money than their spouse or not really have something subject to change. So these digital currencies can be valued in different ways. The largest are on exchanges where you can see the value, but you really need to be careful and do your detective work about what is owned. And then also, when you think about, can it be divided? Well, maybe, although you'll need to do research on the specific exchanges and how things are handled. But also keep in mind, these are not taxed like your dollar bills. So if you had a savings account at Chase or checking, you can go and say you get 50% and you get 50%. Well, in a digital currency, if you bought it for 10,000 and now it's worth 100,000, that could be a taxable event when you divide the ownership or change the ownership or just turn that into cash to give to the person who doesn't necessarily want the volatility of huge changes. So you need to also get advice on what the tax costs would be of division. So needless to say, this is an area that we'll probably be talking about more and more, but we want you to be aware and at least asking the questions, both of your client and of opposing the spouse, so that you have good information and don't miss something that's incredibly valuable in a balance sheet. Same goes for NFTs. And we'll continue to kind of provide information over time as we navigate through the world of digital currency as well. We're always thinking about what's next and what's going on, but we want to think about it in a way that can have the best outcomes for clients and also safety. So when we're advising on which assets you should take, we would take that volatility into consideration as we discussed it.
That was great information, Melissa. I've been running across that lately, and what I find is that it's almost an afterthought. We find out at the very end, oh, and by the way, there was cryptocurrency. Yeah, the person that bought it, they can just keep that. And so that is really important information. I want to talk a little bit about equity compensation, which is stock. So stock compensation, RSUs, ISOs, all of these kinds of, they are an alternate kind of compensation. Doesn't necessarily mean that it shouldn't be treated as an asset in a divorce case, that it should only be treated as income. And I'm going to talk about that a little bit more on the next slide, but I do want to give you a basic definition of what each one of these things are, because they are different. So I'm going to start actually with number 2 here, which is the incentive stock options. So a stock option, so 2 and 3 incentive stock options and non-qualified or non-statutory stock options are the same, 2 different kinds of the same animal. So number 2 and 3. So those are the right to purchase company stock in the future. So it's not generally it's not something that would be owned right now. It's the right to purchase something in the future. So they only have value if the price of the stock goes up in the future. So it's a great way for an employer to incentivize employees who have a direct impact, who they believe have a direct impact on the value of the stock going up. If you're granted the ability to buy company shares at $10 a share, you have an incentive to push that stock value up to, let's say, even $12 or $15 or $20 a share, because when you exercise it or when you take over ownership of that option, at that point, now you've got the difference between the exercise price and the value of the shares. That is an asset for you. So in terms of ISOs, ISOs are not taxed at exercise. And we have to keep in mind too that stock options, there's going to be a vesting period, so a holding period until they become eligible for purchase. Once they become, usually it's 3 to 5 years. Once they become eligible for purchase, they still don't have value unless the option is exercised. So, and this used to be the case when, there have been times when all stock options were underwater, whereas like the price that you can buy it for your option is for $10 a share, but the current stock share is only $8. So we call that being underwater, and the stock options would be worth nothing. I haven't seen very much of that lately, as the stock prices across the board have gone up in the past many years. But we want to make sure that you understand the difference in the way that these would be taxed too. everyone that's listening that's an attorney is probably aware that in Michigan, any asset that has accrued during the marriage and is vested as a marital asset up for division, non-vested assets based on Michigan statute may or may not be considered part of the marital estate. So if we live, let's say, in North Carolina, non-vested assets are considered part of the marital estate. In Michigan, they may or they may not be considered. So that makes everything more complicated because it's gray. But again, in terms of the taxation for when an ISO, it's not taxed at the exercise, it's taxed upon the sale of the actual stock, and it's taxed at the capital gains tax rate. So for people that are high income earners, that's going to be a lower rate than their earned income rate for many people. So that's an incentive why ISOs might be more preferable to higher paid employees. Whereas the NQ stock options, they're taxed as ordinary income on the difference between the exercise price and the stock price on the day that they are exercised. So that is taxed immediately as ordinary income. Plus, once they are owned, upon sale, they're going to be subject to capital gains tax. So they could be, in effect, taxed twice, the non-qualified. So those are stock options. Moving over to what I think is more common nowadays are restricted stock units. And restricted stock units are very different than stock options. Restricted stock units are granted to employees when certain benchmarks are achieved. And those benchmarks can either be time-based or performance-based. So meaning, when you've been here for 10 years, when you've been here for 5 years, now those become available to you. And once they're vested and the restrictions are met, those are going to be taxed as ordinary income, and those are owned outright. So different than having the right to buy in the future, those, once they become unrestricted, that employee actually owns them. And then employer stock purchase plans, generally speaking, as another type of compensation, that would be, we can have non-qualified retirement plans. We can have a whole nother session that we cover on retirement assets too, that might be considered deferred compensation plans. But those, again, the main point here, when you see these in a divorce case, and you always want to make sure that if you have an employee, whether sometimes clients don't know what they have. Sometimes they think they know what they have, but they don't. I always recommend that you go directly through the employer, whether you're working with the employee client or the non-employee client, and you get a list of the information that you need. So you want to make sure that you have the compensation agreement. You want to have the agreement for the options if there are any. You want to have a vesting schedule. We have a list of things that you would want to ask for when you think these might be something that an employee has. And I guess I would go on the assumption that you want to ask in discovery for all the information. And if they don't have it, great, but at least you didn't miss it if you don't ask for it. Once you have all this information together, you might be asking for summary plan descriptions. You'll get reading through that. That's usually sent over to someone like us, an expert, a financial expert that can go through and tell you, well, this is how this is going to be taxed. This is what this might be valued at. There are different ways that you can value stock options. You can use what's called a coverture fraction, which you may be familiar with from dealing with retirement accounts. You can also use a Black-Scholes method. So this is where you want to get an expert involved early to help you look through all the discovery that you have to see what maybe additional information you need and how you want to value and treat these assets, but also whether or not they're actually divisible is something that's really important to find out from all of these documents. So now I'm going to take a look at the real issue here is whether or not they're treated as income or asset for division. So anything, again, that is accrued during the marriage is a marital asset up for division. When we have something that's tied to performance, future performance, or to time being with the company, it's possible that there could be a premarital component of stock options, and there could be post-marital accruals on stock options and RSUs. So in terms of looking at the agreement and what is the purpose, for some people, they're given as an incentive to join the company, to leave another firm. And then they may have been you might consider them to have accrued entirely during the marriage if they're based on past performance and an incentive to join a new company. However, if it's based on future performance and hitting certain benchmarks inside your job, then there may be a component that's non-marital. So again, this is going to be negotiable as you're walking through dividing up these assets. The two main ways that you would treat it, if it's going to be treated as an asset, you either have a buyout. So we've got a value placed on the asset for the employee, and the non-employee is given a buyout amount of an agreed upon amount using an agreed upon method. Or two, you're going to divide them in the future. And deferred division is going to involve something that sounds like a paragraph in your settlement agreement that says, if and when these become payable, these units or these shares will be divided between the parties net of any tax due, and the employee will hold them in constructive trust for the non-employee spouse until they're paid. And then you need to have a lot of safeguards in there about how you're going to go back and make sure that the taxes were calculated correctly, and some fallback. And we always do provide judgment language for that for the attorneys that we work with. We're happy to help. We always feel like it's better to talk about these things in advance than when we get the client after the divorce. Putting the toothpaste back in the tube is where it gets really hard. So we would much rather be involved in cases early, even if it's just to give you some judgment language that will work to make these divisions workable in the future. So let's say you've already treated it as an asset. If you've already treated this as an asset within the divorce case, it's difficult to say that it should be counted as income for purposes of child support modification and spousal support down the road. Again, that would be something that you would want to consider within the context of the case. We would want to avoid a double dipping argument where we said, well, if that was already treated as an asset, it wouldn't be fair to treat that as income. However, if you look at the child support guidelines for Michigan, the most updated guidelines do indicate that capital gains, assets that are subject to capital gains should be treated as income for purposes of support. And the definition of what could be treated as income is very open-ended. It lists out several different kinds of equity compensation and then says, or anything else that might fall under this category. So as far as future income goes, future grants of RSUs, future exercise of stock options for future child support modification, and also possibly for spousal support modification, that needs to be on your radar. And that needs to be something that if the client has been receiving this kind of equity compensation, you want to make sure that there's a mechanism in place for future compensation to be added back into that child support formula if the child support does get adjusted. And it's something that I would also caution you to let clients know when you have a follow-up meeting with them at the end of the divorce with the list of checklist items of things that they need to watch out for. Those are one of those things that they should be aware of, and it may involve having to retain you again and bring the other party back to court, and it may not. It may just be a phone call if they are amicable and cooperative with each other. But future stock incentive grant treatment as income for purpose of support should be considered while the divorce is pending. And again, that's where an expert like Melissa, I refer to them as the Melissas. I'm so grateful to be at Pearl because they have this deep understanding of all different kinds of investments that I don't deal with on a regular basis. And that's where we can really be of value to attorneys.
Jackie, I would mention we are seeing so much more equity compensation in the Midwest and specifically in Michigan relative to what I used to see in the past. So whereas it was a West Coast tech company,
Right.
maybe if you're in Ann Arbor and you're a startup or recently public, then you would see it. Nowadays, it's happening with big three. It's happening in a lot of corporations. So again, this is an area where, you may only run across it once every couple of years, but it's going to be more prevalent.
Right.
So do consider us a resource, because not only in the divorce realm, but just in our general planning realm, this is an area we want to focus on because it's kind of where our clients are going.
So this is an interesting one. This is something that it's shocking to me that how many times in recent cases in the last 6 months, I keep running across some very non-standard assets. So precious metals, oil and gas investments, we have non-standard real estate assets that I see sometimes inside of IRA accounts. Those are all becoming more prominent. And whenever you see those, again, I think that it should raise a red flag when someone discloses that on their financial disclosure, that you're probably going to need to do a little bit of extra legwork. In terms of how to value some of these assets, precious metals, depending on, there's different ways that you can invest in precious metals. They are usually purchased by someone who's looking to buy them as an inflation hedge, or they may be, so they may be for people that are low risk in their investments, and they may be for people that are very high risk in their investment strategy. I have a case right now where we've got gold coins that were involved. So the value of those coins is not just the value of what gold is worth today, but when you're talking about certain kinds of numismatic coins, you also have a value based on the actual type of coin that it is. And so there might be a premium based on that. So that's one of those areas when I see that if there are individual holdings of gold coins that people have in their safes or their basement, which I've seen a shocking amount of these lately. I would say that you definitely want to make sure that you reach out to a reputable store, a location that where they on a regular basis, they will put a value on these types of assets. And I highly recommend that if you've got hard gold, silver, other kinds of numismatic coin collections, that you take that to a reputable seller and they will put an appraised value on that for you. As far as dividing these up, usually there's some emotional attachment held to some of these kinds of assets. And it's, again, important that you make sure that you get a correct value, or that your client feels like if they're not the one keeping these assets, that they've been offered a fair buyout amount. Generally, these types of assets are riskier than your regular stocks, bonds, mutual fund, money market type investments, because it's difficult for a lot of reasons. One is the liquidity. There's no, it's difficult sometimes. There's not a secondary market that's reliable that you can sell some of these types of assets on. I had a recent case that involved many different limited partnerships that were owned through a company that was based in, on the West Coast. And they didn't have any traditional way that they were valuing them. And it was a substantial portion of a very large marital estate. So we ended up getting some experts involved. And, even when we had different experts involved putting the valuation number, a lot of this is just very gray in terms of what that is. So for some of these non-standard assets, if you have clients that own gas and oil or real estate, you want to make sure that there aren't restrictions about capital calls. So that was a big issue for some of my clients, that they might want to participate in owning some of these investments going forward because they think that they're valuable, but are they going to have to come up with money out of pocket for capital calls? And if they are, what happens if they don't have that money, then do they lose that interest? And so that needs to be considered. So again, you want to make sure that you look at the prospectus of these products to see what kind of capital calls, and also ask questions about what capital calls have been in the past in these investments. There are also, for a lot of the oil and gas type of investments, people are investing in these for tax benefits. So maybe you have the client that is the lower wage earner and they're not going to need that future tax benefit. So those are all things to take into consideration when you're looking at these kinds of assets. And again, I personally believe that these are worth a phone call because there's so many different variables here. As always, you want to do the most work you can in discovery. And that's even where, Melissa and I can help, is telling you what to ask for.
And I would mention a couple things that I've seen. I've seen physical gold in a IRA or 401k plan at Fidelity, which if you have an odd number of bars and then you say, hey, it should just be divided, that does not work. I can tell you from experience. So, and then there are also an increasing number of private investments, like what Jackie was describing with the capital calls, or hedge fund investments. So if you can't find a ticker symbol, if you can't look it up on, Yahoo Finance, you may need to talk to someone like us. so that you can get a better understanding of what this asset is. And then we can do some research in conversation. It's very difficult to understand the full, kind of considerations of those types of private investments and their liquidity without knowing all the right questions to ask, including, how would you get tax information? Sometimes it's extremely delayed. The capital calls is very important. And then sometimes there's just not liquidity. It may be something that's locked up for a very long time period, like 10 years. And those private investments, the private investable market is much larger than the public investable market, which is the stock market and the bond market. So keep that in mind. Melissa and I don't know every one of these investments, but we have an extensive network, so we can both get to the answers as well as talk credibly to the professionals involved with the assets, so that you have the right information to make decisions along with your client. So I think is this you, Jackie? Sorry.
I thought it was Melissa, but I'm happy to do it. And I definitely, this comes up so often in cases that we have. Why and when does cost basis matter? So cost basis, first of all, does not matter in the retirement assets. So that is one thing I want to get out there for. So we don't need to, we're not talking about IRAs, 401ks. None of that makes any difference in terms of the cost basis concerns. But cost basis definitely does matter when it comes to your post-tax assets. So very often, again, I am well aware, having worked in the divorce field for such a long time, I'm well aware that you are dealing as attorneys, you are dealing with big issues. So you're dealing with parenting time issues. You're dealing with what is alimony going to be? What is spousal support going to be? How long is it going to last? Who's going to keep the house? Those big issues that once you get those settled, some of these things seem like small issues, dealing with cost basis on the assets, but these are the pain points that clients really feel when their cost basis issues, tax issues haven't been addressed. And so again, I don't think it's realistic for attorneys to think that they can know everything about all of these things. That's why, again, it's really important to get some advice in early. So when I see cost basis mattering is when I see, generally after a settlement is done, there'll be some language in there that says all of the Morgan Stanley accounts or all of the after-tax accounts are going to be divided. These 10 accounts will be divided equally between the parties. So one person sometimes, and in most cases that I work with, one person has been involved with the investment decisions and one person has not. Oftentimes I'm working with the one who has not been involved with the investment decisions. And some of the assets in the portfolio, they may not be appropriate for my client to maintain. And so when I sit down with Melissa Fradenburg or Melissa Joy and I say, which of these assets would be best for my client, they're going to look at the list and say, well, we probably don't want 100% of the, the Amazon stock or something that is, highly appreciated so that when you sell it, you're going to have to pay a lot of capital gains taxes and maybe inappropriate for the client to maintain for their future investment goals, whether that be maybe they're lower risk, maybe they need more cash from their portfolio, maybe they need to have an asset allocation that makes sense for their particular goals and not the goals of the couple any longer. We want to know that in advance because you want to know, I don't want to keep all of the assets that my client's going to have to liquidate and pay all the taxes on, especially the other side might want to keep those. And so that could be a win-win for people. If one person's going to keep those Amazon shares long-term, I'd rather give those to the other side than have my client take half just to sell it and pay the capital gains tax right away. So it's really important. We, in all of our cases, we like to do an evaluation of the after-tax assets to see which ones may be appropriate for our client and which ones not, and try to help negotiate for the ones that are best for both parties. And this might be a way that there, again, is a win-win in the division of these assets. Where taxes also often are not taken into consideration is in terms of a lot of clients that I see have a second home. They have real estate property up north. They have a condo in Florida. When those assets are sold, there may be capital gains taxes due, especially if any of your clients, like a lot of my clients right now, have condos in Florida, and those are skyrocketing in value. So when we're trying to compare apples to apples in the marital estate, we have to look at what is the potential tax liability that's associated with that asset. Because if the client is going to keep that house in Florida, maybe they bought it for 100,000, they put another 100,000 in to improve it, and now it's worth, let's say, 800,000. That is going to be subject to capital gains tax when that is sold, and that could be a big hit for your client. And even if your client isn't planning to sell that asset right away, we know for sure that there's an embedded capital gains tax in there that needs to be taken into consideration. And so again, when we don't look at those things in the marital estate, you're really, it's detrimental to your client. There are also issues with other types of tax considerations that may come up. So you want to make sure that you are looking at the tax return. Capital loss carryovers, you can only claim up to $3,000 a year, but you can carry them over for, in perpetuity. Those are an asset because those will reduce the taxes due for the party that owns that. So we want to make sure that there's something in your settlement agreement or your judgment of divorce language that says that those will be split between the parties, because the IRS does allow for you to split them. There are so many tax considerations that are very specific to divorce that, again, it's important to get some of that tax insight involved while the case is going on, until waiting until the case is done. And then it's, oh, we should have thought about that, but we didn't. And then we have an unhappy client on the back end.
So that's a great segue into my part of this presentation. I'm going to talk about the assets you're probably familiar with dealing with, however, adding into the picture the recent market volatility. So for things like equities, right, we're looking here in this picture at the S&P 500 index. If we look all the way to the right here at the year to date, that bar, we see that we've touched on down 19%. Right now, we're around 14% negative for the year. And this does have an impact when you're working on a divorce case. And unfortunately, in the last few months, I have seen this play out for clients who are working on dividing assets in the marriage. So as Jackie mentioned, it's important to look at cost basis, and she mentioned a couple individual equities. It's also really important to get updated statements throughout the course of the divorce process when you have, especially a year like this, where things are worth a much different amount. If the case has been going on for a few months, as you see, again, down 14% for the index. The other interesting thing to point out is this particular year, we also have bonds negative for the year. So the 10-year Treasury index is down 10% year to date. That is through June 1st. And then the US aggregate bond index is down 8.5%. So you kind of have a double whammy there when it comes to portfolios, even for those more conservative clients that historically would have more bonds to, lessen downside volatility. They're experiencing volatility now in their accounts as well. So I do want to point out one of the nice things about this graph is we've had a few years of relatively low volatility, even with COVID. We had a quick kind of correction in the market. And if you didn't check your statement for the month of March of 2020, you may not have even noticed it. However, this is not uncommon. This is not something that we haven't seen before. If you look at all the red dots in this graph here, we see that intra-year declines are in fact quite common. And what I want to point out is that even with these intra-year drops, the average intra-year drop of 14%, 32 of these 42 years in the bar graph here ended up positive for the year. And I'm not going to make a call on whether we're going to end up positive for the year, but I do just want to point out that while this has been an interesting year and we're definitely experiencing downside volatility, that it's not something we haven't seen before or where the market is down more than we haven't experienced in the past. But I do want to point out that when it comes to asset division, one, make sure that you're not using a 1231 statement, because things like stock prices and overall portfolio values will have changed dramatically. And then also keeping in mind that, because especially when it comes to retirement assets that may be invested in a portfolio of equities and bonds, that there's going to be a period of time before your client actually receives those assets while things like the quadro are being drafted. And I actually had a client back in April who came to my office to call about her portion of the retirement plan. There was some administrative delay before she could take the money out. And in fact, it was dropping about $9,000 or $10,000 a day before they would release those funds to her. And as Jacki touched on, her risk tolerance, her appetite for volatility was much lower than her now ex-husband, and she had no control over how these assets were allocated. So to sit on the other side of the desk with someone and say, we can't change this until they release the funds, this is how it's invested, it's definitely something you want to take into consideration. And especially in those cases where that client is going to need the money now versus for future retirement. So while this intra-year volatility isn't unprecedented, if this is a case where these assets are going to be used currently to pay for things right now, it certainly does factor in. So I am going to talk a little bit on the next slide about what is causing the volatility right now, because it also is having an impact on clients' financial situation. So why have we experienced this downside volatility in both the equity and the bond market? Well, obviously the conflict in Russia and Ukraine has not been positive for the market. It has also put some pressure on gas prices, which if you filled up your car recently, I don't have to show you the graph there, you've probably felt that in your own pocket. We've also had inflation for food prices and general inflationary pressures. Also, even though we have not had lockdowns recently here for COVID, in China, there was a zero COVID policy the first quarter and actually into the second quarter of this year, which also had an effect on supply chain, further driving up prices for consumers here in our country, because they have two of the largest ports that were basically shut down due to their zero COVID policy. So those are a couple factors that have really caused our inflation situation here, in addition of coming out of COVID and that reopening. So what is being done? Well, this also has an impact on our divorcing clients and all of us, which is the Fed is raising rates in order to slow down this inflation, if you will. They have had 2 rate hikes so far this year for a total of 75 basis points, and are expected to increase rates again in June and July, so next week again. What's worth pointing out, though, is it's not just the rate hikes that have already occurred. The stock market is forward-looking, so they're already factoring in even more Fed rate hikes than we'll probably actually get. So again, we won't know. They will most likely raise rates next week. The Fed will likely raise rates again in July, but it's more about what is going to happen through the rest of 2022 in the fall, and then again in 2023. And the market is already factoring in quite aggressive policies. We are starting to see signs that some we may have peaked in this inflationary environment. So we do feel like maybe they won't have to be as aggressive. There's also the idea of sort of a self-fulfilling prophecy. So if everybody is expecting things to slow down, and with the stock market how it has been, that we may actually have a pullback in spending before we are actually in the type of situation that would warrant that. So that may actually cause the Fed to be less aggressive. The main point here being that how are, in addition to the double whammy of having these inflated prices for gas and food for your clients, now you've got increased rates. And what does that look like for a divorcing client? Well, one of the biggest things that we see it in is mortgage rates. So we have the double whammy of increased mortgage rates and record high home prices. So year over year home prices rising 20%. even more in certain areas. And then if you look at the 30-year fixed, now this chart was from a few weeks ago, hits above 5%. I had a client meeting last night, and their mediation scheduled for next week, but likely the client that I met with will be receiving the house. So she needs to refinance her mortgage in order to get her soon-to-be ex-husband off of the mortgage. And when they purchased the home in 2010, it was worth $170,000. It is now worth over $300,000. And mortgage rates, she was locked in at 3.2%. She was just quoted at 6.1% for that refi. So if you think about that, that is in real dollars. That is really something that you have to consider. On top of that, as you probably know, that to go out and buy a new house, if they're going to sell the home, yes, they can get a high value for selling it, but it's really hard and competitive, especially in the lower home price area, to purchase a home. So these are just things that you need to consider when thinking about affordability for refining and how much people are going to need to come to the table to buy out a spouse. This is really a difficult time to figure out those numbers. So certainly something that we can help you with here if you have a particular case. We are dealing with this every day. And I know, as you know, being in different stages like post-divorce or pre-divorce, but this is happening all quickly. These rates are rising. It's important to lock in rates when you're dealing with someone that's either needs to purchase a new home or, again, buy out a spouse or refi a spouse off of a mortgage. And with that, I'm going to pass this back to Jackie to talk about how these rising rates are affecting pension buyouts as well.
Oh, you're muted, Jackie. Yeah.
Okay, so rising rates obviously are impacting housing decisions for clients that are in the process of divorce, but it also affects pension valuations and buyouts, as well as spousal support buyouts. So just as a reminder, the bigger bag of money on the left shows that there's an inverse relationship between interest rates and lump sums when we calculate present values. So the lower the rate, the higher the lump sum. The higher the rate, the lower the lump sum. So we are heading in the direction of higher rates equal lower lump sums. And the way that that impacts pension valuations, we don't very often have marital estates that are large enough. Usually the pension is the largest asset owned by the parties. So we don't usually have, I don't come across, even in high net worth cases, situations where people have the ability to buy out their spouse's interest in their pension. But when they do, we've been starting to have the conversation now more and more about what's an appropriate interest rate to use. And when I do a pension valuation, I use a standard formula and a software program that requires me to use the 20-year average of 20-year treasuries. So I noticed that whereas I might have been using 2% in December, now I'm using a little bit over 3% when I'm doing that calculation. And so the lump sums are getting lower. I was talking to a client this morning and explaining to her that that's a good thing for her, because she really wants to buy out her husband's interest in her pension. So as we continue to go through the process of the divorce, with the anticipation that the rates are going to continue to go up, that buyout number continues to get lower. As far as spousal support buyouts, which I see all the time, that's different than pension valuations and buyouts. That rate that we use is negotiable. There isn't any one set rate that we have to use. So I sometimes have, depending on which side I'm working with. For me, I feel like everything has to pass what I would call the black robe test. So I use a rate that I always think is reasonable. I wouldn't use a very high rate because I'm working with a client that wants a low number, or vice versa. So to me, the guaranteed rate is the rate that I typically would go with in terms of a spousal support buyout. But we're having a lot of conversations now about whether or not that guaranteed rate should be something in the 2% range or something in the 3% or 4%. I have attorneys saying, but the stock market has been up so high, we should be using a much higher rate. But again, there's no guarantee that those stock market returns are going to continue in the short term. And so when we're looking at buyouts, I like to use what I would consider to be the guaranteed rate. But again, it's important to take a look at the numbers. I do find that more and more attorneys are aware that interest rates are affecting buyouts, but then we come into conversations about what the appropriate risk-free return is. And different experts, we could line up people all around the room and they could all give you a different opinion on what is appropriate. So these are all things that do affect those numbers, and there isn't any one guarantee. They're all guesstimates because we really don't know exactly what the rates are going to be, even going forward a month. So these are again negotiable items in a case. So we've talked about a lot of things today. We've touched probably just a tip of the iceberg of how what the benefits of working with the CDFA are. I would say that number one, for any attorney that's watching this live or on the replay, if you have a financial expert that is familiar with divorce, that you ask them if they can review the financial sections in your judgments and your settlement agreements, just to make sure that they logistically can happen. So I can't tell you how many times in preparing quadros, I would get a settlement agreement that says that we're going to be dividing up, this plan, this plan, this plan. And then I take a look at it and that's a non-qualified annuity that can't actually be divided. And then we have to go back to square one with trying to figure out what an alternative is. So same thing with regard to tax issues, language for constructive trusts, for deferred assets that are going to be divided in the future between the parties. All of that, you may as well get the advice upfront. And I know that at Pro Planning, we have no problem being called and asked to just look at the judgment language in a case to make sure that everything looks good for our client. You want to also lean on a CDFA to consult on tax concerns of transferring assets, having them evaluate cost basis, having them take a look at the tax return to see if there are any maybe hidden assets that only would show up on the tax return, that someone who's experienced at looking at those would be able to advise better on that. And I would say too, that another big benefit, I had the woman that I was talking to earlier today about her pension valuation and buyout. We went online together, we shared our screen, and we were looking at the difference in her taking a straight life annuity versus a joint and survivor annuity. So she was dead set that she was not going to give her husband a piece of her pension, that she was going to buy him out. But when we took a look at the difference between the joint and survivor amount, because she was convinced that the single life annuity would be so much better for her. We looked at the dollars, and the difference to her was about $50 a month because there's a big age difference between them, and she was a lot younger than him. So having that kind of information, she felt such a relief when we got off the phone, because she knew what she should be digging her heels in about and what she shouldn't be. And we ended up, having that very quick conversation with her, going through that together, giving her that advice. It helped her understand what she really wanted, what was really important to her financially and what really wasn't, maybe what was more emotionally important to her. So those clients that feel like they had that kind of deep dive in their finances while the divorce was going on, they're happier on the back end. Even if they don't get what they want, that understanding of what their settlement is and what their next steps are, they become better referral sources for attorneys that they work with because they're happier on the back end. There are also many benefits that clients can have of working with a certified divorce financial analyst, different than their current maybe financial advisor. A lot of clients that we work with, they maybe don't have a relationship with their financial advisor. And so they're looking for that help after the divorce is done. But some of them do have a financial advisor, and general financial advisors that aren't trained as CDFAs usually don't have that very narrow down expertise that's so specific to divorce in Michigan and Michigan laws, and also the tax and overall legislative issues that are involved with divorce that a general financial advisor might not come across all the time. So clients benefit from going through in the divorce process, that they understand what their post-divorce circumstances are. A big part of what we do is run through financial projections for clients that show them Based on settlement A, this is what you look like in 5 years, 10 years, 20 years. Based on settlement B, this is what you look like. We give them the control to make the decision, but we're giving them more information. And so understanding up front, when I look at these numbers, it looks to me like maybe I can't keep my house. That is a process for clients to work through. I usually find that in those situations that takes some time, maybe 3 months, 4 months, 5 months of looking at the numbers again and thinking about it. But those clients are happier when they understand upfront rather than waiting until 3 years down the road and realizing that they have to sell their house at that point because they've spent all of their money on trying to maintain it. Also, clients are able to advocate for a better financial outcome for themselves. They become a better advocate. Like my client today, she really was dead set on one thing. When she looked at the actual numbers, it didn't make sense for her to be dead set on that. So she becomes a more effective advocate for herself. And also she becomes a little bit more reasonable to work with her attorney, because that information is powerful. Also, in terms of managing complex financial situations, we have clients that have issues with separate property and an inherited property. We've got issues that deal with unusual types of assets and how to liquidate them and how to transfer them. Those are all things that clients that are working with specific, divorce financial advisors have experience in that and can really hone in and help them on those things. And probably most important, the most stressful time for your clients, believe it or not, when the divorce is done, they think they're done and they're not done. And I've written blogs about this. We've worked with this clients on the back end. For a lot of people, it might be up to a year before all the accounts are transferred and all of the transitions take place. Clients don't know how to fill out the Quadro forms. They don't know I was looking at some forms the other day from one Quadro preparer, and they were asking questions that I wouldn't possibly anticipate the client to know. The plan administrator's phone number, which plans are being divided. So those are the kinds of things that we can help clients with that save them a lot of time and aggravation and phone calls to your office after the case is done, because we can help with the logistics, even when it comes to things like getting the refinance process through and helping them gather together their financial information for that. Dividing up post-tax assets, figuring out how Melissa said, you've got 10 gold coins or you've got 12 or say 11, and it says equalize them, but it's not an even number. You can't divide them in half. Clients don't know where to go from that point. They are so used to depending on their attorney, and then they're just let loose. And even if they have a list of things that they need to do, that includes changing beneficiary designations and all of those things that need to get done, that's our job. Our job is to help the client make sure that they actually get that work done and that they're happy.
That is such a big deal, Jackie. I am opening things up to questions, but I'll just comment. There is a Q&A section in this webinar. So if you type any questions, and we'll be here for a few more minutes, we'll be happy to try to tackle them. And we're also going to give you our contact information. But I would just say it's such a nice transition. I'm meeting with someone later today who was divorced last year, and it took a while to find her house because of that tight housing market. And also, we always encourage people not to rush big decisions if they have the option. And so we're going to sit down now and look, and I'm going to reiterate that her overall long-term financial plan works out with the purchase of this house, because, you can see the numbers once, but there's a lot of uncertainty that's involved in spending the assets of a settlement, and, kind of reorganizing your life based on the outcomes. So I think that's such an important aspect to consider. And we both have the technical expertise, but also we see these clients as the beautiful flowers that they are, the unique humans. And so I think that's a skill that's very important in your relationship with your advisor over time. I would give a quick plug. Melissa and Jackie have a new podcast, brand new. The first episode just came out, but we're going to have episodes every other week called Wealthy After Divorce. And the target kind of audience is people going through divorce or post-divorce. And we're going to have all sorts of topics that help people to think about the personal and emotional wealth that you can have, as well as financial wealth, with good divorce outcomes. Any comments that you would mention, Jackie or Melissa, on the podcast as I'm pulling up our questions?
We're so excited to be able to do this. Melissa is an amazing podcaster. And so I'm really grateful to have the opportunity to do this with her. If anyone has any topics that you'd like us to cover, please let us know. We'd love to have guests. We've had several guests already that we've taped, all related to divorce and everything that comes after putting together a wealthy life for yourself, whether emotional wealth or financial wealth. It means something different to everyone, but we're so excited about this podcast.
Yeah, I'm very excited, and kudos to both of you, because it's really, I think, going to be very valuable for many people over time. We do have one question, which is, how are we compensated? And I will answer that. It depends if you're during divorce or post-divorce. But my first answer after I give you the specifics is that we always are, upfront how you're going to pay us. And it's a conversation that you're not left kind of scratching your head or guessing. During a divorce, typically the compensation is an hourly fee. So Jacki's and my hourly rates is $300 an hour. And, we're not trying to, the goal is not to bill you as much money as possible. The goal is an efficient divorce. Sometimes that can reduce the hours that might be involved with your attorney. No guarantees across the board. And in some cases it could be 2 hours, and in some cases it could be 30. But we talk to you all about that upfront in a free initial consult call. And post-divorce, either we have financial planning fees if you're not going to be investing with us, or even investment under management percentage. And all of those are detailed on our website. There's an area on the pricing. And also, like I said, very straightforward conversations. You're not kind of left guessing or scratching your head like, I'm not quite sure how I'm paying that person. I know they're very excited to talk to me every time I call, so I must be paying them something. But we also operate as fiduciaries. So we're also always thinking about what is in your best interest when we work with people. And for any of you who don't know us, here are some details. We have both, I'm sitting in Dexter, Michigan, which was our first office and our headquarters. Jacki is in Birmingham, Michigan, and Melissa's in Grosse Pointe, Michigan. So we have offices in each place, but we really operate as a team, and we cast a wide net. It's surprising because we sit in different locations most days, how cohesive the unit is, but we're really able to blanket all of Southeast Michigan with our offices and our support. And then, we have clients throughout Michigan and actually around the country. So I'm going to hang on for just one moment to make sure there aren't any other questions. But Jacki, Melissa, is there anything I forgot to mention? I would mention, if you go to our website, you can put in the search divorce, and you'll see a lot of blogs, topics that relate to divorce. And we also have newsletters, both for general financial planning as well as for divorce related topics. So if you go to our website or reach out to one of us, you can find those newsletters where you can see all 3 of our emails. So we'll make sure to get you on that list. Oh, one more question. Oh, just an excellent job. Well, thank you, Amanda and Bo, for that. And thanks to everyone who attended. We will have a replay. So if anybody needs to hear this, you can just go to our website and find that replay, or go on YouTube.
I have one more little thing to add.
Great.
Pearl Planning also has a fantastic podcast called 52 Pearls, where they give out weekly money wisdom advice. And I've been listening to it in my car. And it is a great resource for attorneys, but also for clients, that it just covers some really good, solid, basic financial planning information in a way that is easily accessible to people and understandable and relatable. And so I would definitely recommend that.
We love the podcast, and Melissa and I have been doing that podcast weekly. And that's where Melissa, who's our podcast guru, cut her teeth on becoming an expert in podcasting. This week's episode was on inflation. So it was a great topic. Melissa, I listened to it the other day.
Thank you. Yeah. And I would just reiterate, please go to our website, sign up for our newsletter, and reach out with topics. As attorneys that are dealing with these cases every day, we would love to hear what you think, what you would like to hear as an attorney, but also what clients would benefit from. And that's extremely helpful. And we'd love to have you as a guest on our podcast as well.
Well, with that, we're going to say goodbye, but hopefully not for long. So don't hesitate to reach out with follow-up questions. And Jackie, Melissa, this is so interesting. There's so many topics we can speak on. So this won't be our last event. Keep an eye out and we'll talk to you soon.